Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Surbhi Upadhyay and Pavitra Parekh. And the girls' markets are slipping a bit, right? In the red now for the Nifty as we speak. From the top of the trading session, the Nifty is now down 90 points. And that sell-off is just taking place in the last 30 minutes or so. Flat now for the benchmark indices. The sensex 2 is just blinking red and green. For the week so far, the Nifty is down 2.2%, while the mid-cap index has relatively performed better. The mid-cap index is down 1.2%. The biggest drag is coming from the metal index. The Nifty metal index is down about 2.5% today. And for this week, the metal index is down more than 5%, almost inching towards that 5.5% knock. And that's where a majority of the selling pressure has come through. Hi, what are you tracking?
Hi, Reema. Yeah, I mean, I thought I'll talk about the winners, but then this market changes color so quickly and so dramatically. Actually, for what it's worth, I mean, banks have been trying to put some sort of a fight up. The Bank Nifty relatively doing better than the Nifty even as we speak. Actually, no, not anymore. The Bank Nifty is now slipping more than the Nifty. So things are changing very, very quickly. And this is where the bulk of the decline has come in from, because when the market opened up, the Bank Nifty was up, cruising around 0.5% higher or so. But nerves and, jitters pretty much back on. And now we are fighting around the 17,500 mark all over again. Pavitra, I was listening to Gautam Shah's commentary quite carefully in the morning. And I think some of the views on the street are still very, very bearish. People are watching for these levels because we're close to the budget day lows now. And a breach below that simply just triggers more selling. We're starting a new series. Definitely not on a very optimistic note, because the market's not been able to hold any sort of the morning high whatsoever. What's on your radar?
Oh, absolutely. And like Reema was pointing out, the metals pack has been under pressure. This week alone, it's a 5% kind of cut. Take a look at some of the smaller companies as well. We've spoken about the larger ones, but take a look at some of the smaller mid-cap metal names. So something like a Nalco, you have NMDC, JSPL, all of these are seeing pretty sharp cuts. And this is what is really taking the index lower. The other big loser for this year, like we all know, has been the PSU Bank Index, right? Once again, a lot of those stocks are seeing some red. By the way, the PSU Bank Index in 2023 so far is down over 15%. This week, it's down around 4.5% as well. So that's definitely the other big loser. You have many, like the likes of Bank of Baroda, Bank of India, Punjab and Sindh Bank is down 4%. These are just a few of the names, but there are cuts across the board over there. Today, what's doing well are some of the sectors which have been under pressure in the past few days. So, real estate and pharma is what's coming up. Pharma, some of the larger names include the likes of Divi's, but you have smaller ones as well over there. And this is the real estate stocks which are doing well. DLF is up. Indiabuls Real Estate is up 9%. Oberoi Realty. So, I mean, of course, this space has also seen cuts right through the start of this year. But today, it's holding up fairly well. And some of the new age companies this week, for instance, Zomato has come up with a near 7% gain. You have PP Fintech, which is doing well today as well. So that is what we're watching in terms of the market action. But let's now talk about some individual stocks. DLF, like I was telling you, is in focus. There's also an ICICI Securities note. So Sonal is here with all of the highlights of that note. Sonal?
Thank you so much for that. Well, DLF has been on a launch spree, and this Feb itself, they launched a big project in Gurugram. That is what ICICI Securities is talking about. It is called Arbor, and it is at sector 63 at Gurugram. It is a total area which is being developed of 4.4 million square feet and has a potential sales value of 8,000 to 9,000 crore itself. Now remember, company had earlier guided they will be launching around 3.1 million square feet in fourth quarter of FY23. They have definitely surpassed that guidance as well. According to channel checks from ICICI Securities, it shows that there is significant buyer interest here as well. And company they might just look at selling the entire inventory at launch itself, or they might hold on to it in order to see whether they can take price hikes consecutively on this project sale as well. Quarter 4 FY23, they are assuming will see bookings of 5,000 to 6,000 crore rupees in this quarter, and the rest will be done in FY24, on the back of which ICICI Securities has gone ahead, raised their bookings estimates both for FY23 and FY24 by 17%, and have also raised the target price to 458 rupees versus 450 rupees per share earlier.
Okay. That's quite an interesting increase on the target there. But Sonal, before you go, what's troubling Mahindra Life Spaces? 4% down. There's a management change that's causing this?
Oh yes. In fact, the management of Mahindra Life Spaces spoke to us just 2 days back, and now there is a change. So the existing MD and CEO, Arvind Subramanian, he has resigned. This news came during market hours yesterday. They also said that the group has appointed Amit Kumar Sinha as the new MD and CEO. Amit Kumar Sinha, he has been working been with the group as the president of group strategy since April 2021, and he has been with the group for 18 years now. The company actually held a conference call yesterday post-market hours where they reiterated that there's nothing wrong with the fundamentals. The business will go on as usual. They spoke about their 2,500 crore booking target by FY25. They're ensuring continuity of key management across verticals and focusing on bigger markets like MMR, Bengaluru and Pune as well. They will also communicate long-term plans to the investors in due course of time. However, what worries the street is they declined to comment on the departure of Arvind Subramanian, and also that management transition comes at a time when the growth strategy was always in place. Since the time Arvind Subramanian has taken over, sales have been higher. In fact, in 9 months of FY23, sales were 22% higher than what we saw in FY22. They also won their first society redevelopment project in Mumbai with a sales potential of 500 crore rupees, and that has been the big trigger for most of the real estate developers in Mumbai itself. So this is something that could be worrying the street. The change in hands from an experienced person as well. However, ICICI Securities says that if growth plan is in place and the management is reiterating their long-term plans, there's nothing to worry. It's not a risk. So they continue to maintain their buy on the stock.
Thank you very much for that. Let's talk about Zomato, and this is higher in trade following the pilot launch of its home-style meal services. Mangalam is here with the details. Mangalam.
Well, it is a pilot launch of home-style meal services. Like you said, it is basically called Zomato Every Day, where they will sell and deliver home-style meals at 89 rupees per meal. This is a plan which, they've replaced the earlier pilot plan with, which was basically Zomato Instant, which was 10-minute delivery, which they had started in about 4 units in the north of India itself. And they believe that that wasn't doing as well. So this is something that they would try and see if that works or not. But from a business standpoint, this makes more sense because, one, this increases order frequency, and at the same time, it does not have concerns with regards to the quality or the assortment that there is, because at 89 rupees with no time limit, so to say, on a daily basis, if someone can deliver home food, then there, I'm sure, would be a fair amount of takers for that. But then again, this is a pilot, so let's see how this goes.
All right, Mangalam, thanks a lot for bringing us the details there. With that, let's also bring you some important corporate commentary. TTK Prestige Chairman T.T. Jagannathan told us this morning that the company is closing in on a potential acquisition. The size is, likely to be upwards of 500 crore rupees. He also, however, did raise a red flag on the domestic growth, saying that the rural market has actually slowed down considerably. So let's listen in to some of those comments.
We are trying to shift volume from the domestic to export because domestic is slowing down.
Yeah. Okay. I want to talk a little bit more about this domestic slowdown, because in the context of you adding capacity in Gujarat, what would this mean? A, what would your total capacity rise to? And once the whole capacity comes on stream, what will that help do to your revenues?
We've added capacity in different areas. We've added capacity in non-stick cookware, in roller coater cookware, in stainless steel cookware, hot anodized cookware, various different businesses we've added capacity. So I can't tell you what percentage, but it'll add about 500 crores to top line if we use it fully.
You said that the entire pressure cooker category has slowed down. And of course, you can't compare it to, the COVID levels, because that was a different consumer pattern. But now that, COVID is behind us, do you think the slowdown is temporary, or do you think it could be a little more long drawn?
My view is that it's temporary. You see, the rural market is penetration is almost zero. And with induction and gas going to the rural market, they'll have to start buying pressure cookers. I believe it's a huge growth story in pressure cookers.
Mr. Jagannathan, you've been in the market at times. You've said that maybe inorganic growth is something that you could look at. Are you scouting for something as of now? Should we hear something?
I'm afraid I can't talk about it at all.
But are you on the, we don't want a timeline, but are you still on the prowl?
We're on the prowl, yes. In fact, we're almost nearing destination.
Sorry, we are almost?
Nearing destination.
Oh, wow. That'll be interesting. Okay, so then let's push it a little bit more. By the first quarter...
No more.
Okay, what could be the rough size, Mr. Jagannathan? What could be the rough size?
What could be the?
Rough size. The destination, what could the size be? 500 crores, 200 crores, 300 crores, what could it be?
About 500 crores.
About 500 crores. And the cash in your books is?
850 crores.
All right, so you could fund it from that. Interesting.
And are you looking at this calendar year itself?
we're low hoping for that, yes.
Okay, so that was TTK Prestige, Mr. Jagannathan there, pretty much saying that they're closing in, they're nearing the destination, so to speak, when it comes to that acquisition. Stocks holding up quite well in trade today. Let's take a quick break on that note. We'll come back on the other side and get you the latest from the commodity universe. Manisha Gupta is going to be with us. Okay, the news from the street is that we're back about 4 points up in positive territory. So it's choppy, but at least right now there's no big, huge slide that started now. But let me not speak too soon. You never know with this market. Let's move to commodities and figure out what's making headlines over there. Manisha is joining in. Manisha, happy Friday to you. What's on your radar today?
Well, I'm looking at the crude oil price, Surabhi, because, every single day, starting from Monday itself, we've seen 2 to 3% of a move, a day of upside and another day of a decline there. So after a decline of nearly 3% on Wednesday, yesterday was 2% on the higher side. And today, right now, we are trading nearly 1% on the higher side. So the last 24 hours actually have seen positive cues returning in case of the crude oil prices. So almost from $74 for the US crude prices, we are back at around 76 on your screens right now. And this is after Russia says that they are planning to cut crude exports from their western port, and this would also be to the tune of 25%. This is what is added premium to the prices here. Remember, Russia already has reduced output for the month of March by 5%, and this could be in addition to that. So the markets are looking at lower supplies coming in from Russia. That has been supportive. The other has been that you are looking at stronger demand from China. The month of Feb has seen higher loadings. That is where the support is coming in from. And even as you are looking at a 9 straight weekly gain in sense of US inventories, markets still are trading it on the higher side. The US gasoline inventories have also continued to gain up to nearly 17 million barrels as we look at the latest numbers there. So even as the inventories in the US is increasing because there is lower supplies coming in from Russia and stronger demand from China, that clearly seems to be supporting the markets. The reports also suggest that for China, there are new refiners also coming back on stream. So the demand could actually even get better for the month of March there. Having said that, we did see prices gain up by 8% in the month of Jan. Feb has seen a 6% decline, and for YTD right now, the crude oil prices are down by 5%. So still trading in the negative for the year for crude.
All right, Manisha, thanks a lot for getting us that quick check on the crude prices. We do have to get into a short break now, but as we do that, here's the latest from the corporate world. EY honored the very best the business leaders at their annual Entrepreneur of the Year Awards. Cipla's Samina Hamid was awarded Entrepreneur of the Year in the healthcare category. Here are some visuals from the event. Hey guys, welcome back. You're still tuned into Trading Hour. There is a little bit of an attempt to a move higher. The frontline index is absolutely flat, but the mid-caps are doing slightly better, around 0.25% higher there. So it's a 60-point gain that you're seeing on the mid-cap index. And the banks have also moved into the green. That is where we were seeing some pressure. So that index also has moved into the green right now, just around 40 points higher, but very, very quiet as far as the key indices are concerned. Let's talk about some individual companies now. Poly Medicure is the one that we're tracking. The company posted quite a good set of Q3 numbers. The revenue growth came in at around 24% versus last year. In fact, the company's margin has also expanded in this quarter. So we have Himanshu Baid, Managing Director of the company, joining us now. Mr. Baid, thanks a lot for joining us. This is Pavitra. If you can just begin by talking us through the revenue growth. It's been quite good at around 24%. I think for 9 months, you're clocking around 800 crores. Can you tell us for this quarter, what is the split between revenue from exports and the domestic market, and what is the kind of growth that you've seen in these segments?
So thank you very much. I think we are seeing a good growth in the export segment, especially from Europe, and that's growing around close to 25% year on year. And when we look at the domestic market, this year the growth is slightly muted to around 15%, because last year the growth was mainly on account of COVID products. So if we remove the COVID products, which were like oxygen products, kind of masks, and ventilator circuits and all, which we are doing, so that if we remove that part, then probably the growth is around 25% also in that segment, because the COVID product sale is not there anymore. But overall, we see a growth of around 21%, over 21% in 9 months. So, and we'll see this growth in coming quarter, also similar growth. And for next year also, we have given a guidance of over 20% from the current scenario we see right now.
Okay, so FY23 you should end with about a 21% revenue growth, and FY24 will be about a 20% revenue growth. You've also guided for improvement in margins next year by 100 to 200 basis points. Can you tell us what will drive this margin improvement? And will there be any margin improvement in FY23?
See, I think FY23 continues to, if you see Q3 results, there have been improvement in margin already. And I think as we move on to the next quarters, margin will keep on improving because the raw material prices have come down a lot, because most of our raw materials were imported, they were coming and it's more petrochemical based. So prices have dropped from the peak, I would say, which were in, let's say, May, June last year. And now the prices have almost dropped by 30-40%. And similarly, the freight costs have also come down, drastically. It's almost half of what it was maybe a year ago. So all that will help us in improvement of the margin. And also maybe currency will slightly play a better role because we have 70% export revenue. So overall, we see at least 100 to 200 basis improvement, going forward in the next couple of quarters.
Mr. Baid, some more color on products. I mean, as you mentioned that last year it was, for obvious reasons, it was all about ventilators, masks and, oximeters for obvious reasons. What are the key revenue driving products for you now? And maybe a word on the US market as well. I believe you're looking to make further inroads in that big market.
Correct. So I think, we are only in consumable business basically. So all consumables used in hospitals for oxygen therapy basically. So that was a lot of business happening last year because there was a great demand for these products, India and outside India also. But when we see this year, that demand is kind of dropped out completely. And the growth is coming from our infusion therapy and renal segment right now. So both the segments are doing very well. And when we look at US business, we are still waiting for US FDA approval. The final filings will happen in next maybe a week to 10 days. And after that, we are expecting the revenues to start from Q2. We still have a business in US, which is over $1 million today. But I think once we get our FDA approvals for some new category of products, we'll see a huge ramp up. And I think with China Plus One happening right now, a lot of companies are looking at manufacturing products in India. I think that's an area we are exploring right now.
So just a follow-up question. You mentioned you're looking for these FDA approvals. Are they in the same categories you mentioned, the renal segment, the infusion segment, which is driving growth for you right now? And once... Yes.
It will be in the infusion segment. Infusion segment.
So once these approvals come in, can you typically command higher prices for these products in the US market? I'm just trying to understand if net there'll be a positive impact on margins or whether this will be more a volumes increase that will play out. Q2 onwards.
So I think US is anyways a high margin market. So we will see a better margin coming out of these products from the US market. That's pretty sure. So I think our margin, Europe and US will almost remain in the same zone. So when you compare with Asia or Africa, the margins are lower, but in Europe and US, the margin will be at a similar level. So I think that will help us to improve margins as the volumes grow. And also, when we look at, and most of these products are patented devices. So we will have a better, lesser profitability in these kind of products.
Okay, Mr. Vaid, you said that you do expect these approvals to come through from the US. How much do you think the US will be contributing going forward, and what is the level right now in terms of contribution? Yeah.
The current level is just over $1 million right now. But I think once we look at these products getting approved, so I think in 3 to 4 year window, we would see revenues going to around 10 to, let's say, $15 million. That's the rough estimate I see right now. It can be more also, but it depends on how things are going to shape up after this China Plus One strategy. What is a lot of US companies are driving right now.
I believe there's some dumping of products taking place by China in the renal business. Could you elaborate a bit more? What exactly has happened and how do you see this play out?
See, there are two things right now. I think most of these Chinese companies are, misusing the FTAs, and they are setting up pseudo manufacturing facilities in Thailand or Malaysia. And from there, they are dumping products into India and they get a duty waiver because from those neighboring countries, we don't have any custom duty on imported products. Secondly, I think what we see is most of these companies are selling products below the import price in India. So if you look at the import price and the price they are selling in India is much lower. So the clear strategy is to eliminate Indian manufacturing. And I think that is where we are struggling. And also there's a very low GST on these products. So whereas when we make in India, we pay around 18% GST on all the, let's say manufacturing, let's say raw materials, whereas on the finished product, GST is only 5%. So when the Chinese bring the product into India, they pay only 5% IS GST. And whereas we pay almost 18% on our imports and 5% on our outputs. So we have a lot of inverted duty structure on the product.
So have you lost market share on the back of this? Have you lost market share?
See, we have not lost market share. I would say the growth we were anticipating was around 60 to 70% in this business. We'll be probably getting only 40, 45% or 50% in that range in this current financial year. So that is kind of hampered the growth a little bit. And the product is also part of the PLI scheme. So we have been going back to the government and telling them that they have to do something on these FTAs and also this inverted duty structure. Otherwise, the Chinese will keep on dumping the products in the market.
And as things stand, in your FY24 guidance of 20%, what is the growth that you're anticipating from renal business? Are you expecting this dumping to continue, which will keep your growth suppressed?
See, overall, the company will grow over 20%, so there is no doubt about that. So we have factored it in our, future guidance. But I think dialysis business, which we were hoping to grow to, let's say, around 50 to 55% next year, maybe grow around 35 to 40%.
Okay. We'll leave it at that. Thank you very much for joining in. That's the word from Poly Medicure. Today, the stock is down 3%. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar of earningswave.com will join in. Welcome back. Let's talk about the market technicals. Mitesh Thakkar, as always, is with us on the show now. Mitesh, off from the day's high. We're holding up in the green now, but just by a fraction. Thoughts on the day so far, the morning and the trading picks?
Good morning, Nima. I think a very quiet kind of day. We did open up, but that texture of selling on rallies, I think, remains, and that's why we've kind of come off from the days. But there are two things. One, there's a strong support around 17,500, 450 zone, which is a historical gap. If you go back on the charts in mid of October, there's this big gap. So that gap becomes a support area. And then the 200-day average, which is about 17,360, 365 levels, that's also the next support area. So the overall structure is weak, but I don't think we're going to get a big expanding move on the downside. So the idea should be that rallies should be used to sell into. So that is a good way to capture some kind of decline from higher levels. Having said that, 17,650 is where I think aggressive shorting can be done. And 17,750 would be a good stop loss with targets of 17,500, possibly 17,370. And on the stock side, I have one buy and one sell. Hindalco is something which is breaking down today. That's a sell with a stop at 426. Look for targets of around 400 here. And earlier in the day, we had a buy on Gas Authority. Gujarat Gas, I think, is something which has caught my eye right now. That's a buy with a stop at 503 for targets of 525.
All right, got that. Thanks very much, Mitesh. You have a good rest of the trading day. We'll catch you in the afternoon. Right now, a very quick break. We'll come back on the other side and get some fundamental ideas going in this market. Varun Lohkab of HDFC Securities is going to be joining in. Welcome back. Here with us on Trading Hour. The market is as flat can be, less than 1 point down on the Nifty. That's how it's playing out. The Bank Nifty is also completely flattened out. At least there's no bigger decline from the bulls' perspective. I think they'll take heart from that. But let's get that conversation going with Varun Lohkab, Head of Institutional Research at HDFC Securities. Varun, good morning and thank you for joining in. The season has been all about the talk of downgrades and how estimates are getting pruned. I was looking at your note. I think you've also reduced estimates for FY23, I believe, by 1.3%? Your summation of what the season tells us, do we really have to worry about corporate growth and profitability?
I think in our case, overall downgrades wasn't a big number. If you see FY23, 1.3%, FY24 is largely flattish. I think there's a marginal upgrade 0.3. But part of the reason is we were, anyway conservative. We were cautious at the start of the year, this financial year, and our earning estimate for the full year was in single digits. And we were calling that out, that street estimates will get downgraded. So I think this year would be single digit, and then next year, as of now, it's 15% earning growth. While there are some downside risk, I am not overly worried on overall earning growth of Nifty. We don't see any big reason for earning downgrades per se, but at the same time, if you look at the breadth, I think this quarter, what was slightly more negative than the headline earnings was the breadth. That this time around only 40% of our coverage companies, which is 220 odd companies, beat estimates. This number was hovering around 50 to 60% range consistently over last 4 to 5 quarters. So which means that there was only a handful of companies which helped maintain the overall Nifty earnings in a certain band, but in a broader market, the pain was there. And we believe while this will, I think, sequentially improve slightly, because from Q4, the benefit of lower commodity prices will come in more into the P&L. This quarter was saved entirely by BFSI. If we were to X BFSI out, then there was a decline in earnings. BFSI will take a bit of breather going forward. It will still be very healthy, but may not be able to save the day for rest of the sectors. But rest of the sectors, we believe, will marginally improve. So net, not overly worried on earnings, but there could be some marginal downgrades to FY24. As of now, the chances of downgrades are slightly more than upgrades, but it won't be a big material, 10-15% kind of downgrade. There might be 2-3% kind of downgrades. So it will be a slow grind kind of an year, where valuations are anyway still a bit on the higher side despite the consolidation of last 1 year. So this year will again go in consolidation in our view. Earnings will probably chug along at that low teens kind of growth rate, and valuations will come down. So net your returns will be very muted at index level. That's our base case scenario.
Varun, you have been calling out that this year one shouldn't expect very high returns from the market, and this has been your consistent stance. But just want to take that point forward. FY24 earnings growth estimate is 15% from you. This compares with just 9.5% for FY23. What could be the extent of downgrades? Does this 15% number come down to 10%? Does it come down to 12%? Because even at the beginning of the year, if I had asked you about FY23 earnings projection, it would have been higher than 9.3% that it currently is. So this year, through the course, we have seen downgrades.
Yeah, so but most of the downgrade this year, we were in single digit after Q1 itself, after the commodity shock which had come in due to the war. And ever since, we have not seen material downgrades. Next year, what can bring that 15% down to, I would say 10%, probably. If I look at the components, I think BFSI, we are already building in a sequential NIM contraction. So I really doubt BFSI will pull it down significantly, maybe 1-2% if credit growth really slips due to higher interest rates. So BFSI, I would say we are not so much at risk because we are anyway building in a decent sequential NIM contraction over the next 2 to 3 quarters, which actually may not come through given that if we still have rising rates. IT, we are building in around 8-9% kind of a growth. I think there is a possibility of maybe a couple of percentage points shaving off out there. Barring that, the only scenario in which I think that earning downgrades will happen in the rest of the sector is if we see a spike in crude, back to 100, 110 levels, because then the commodity consuming sectors where there is a bit of earning upgrades or say earning growth being higher built in for FY24 may not come through. So I think that is something to watch out for. If commodities remain where they are, I think somewhere between 12 to 13% earning growth we should at least get, if not 15%, is what my view is.
Okay, 12 to 13%. Varun, we would have loved to chat some more, but unfortunately we're completely out of time. So we will continue this conversation, one of these coming days. For now, get into a short break. When we return, we're going to bring you excerpts from our exclusive conversation with DLF's Chairman Emeritus KP Singh. Stay tuned. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. We've slipped back into the red. It's around 16 points lower on the frontline index. The banks are absolutely flat right now. So, I mean, it's just blinking red and green on the markets. But let's go back to the latest from the corporate world. EY honored the leading industrialist at its annual Entrepreneur of the Year Awards. KP Singh, Chairman Emeritus of DLF India, was confirmed the Lifetime Achievement Award. Shireen spoke to him on a whole host of topics, including stepping away from his executive role. Listen in.
I want to pick up on something that you just said, that you live outside. Yeah. You are now a non-resident Indian. You spend more of your time in London and in the south of France than you do in India. Yeah. Why is that the case?
Because it's a very personal thing. You see, perhaps there are few examples. I had an excellent married life, and my wife, late wife, was not only my wife, but was a wonderful support and friend to me. We were highly compatible. We grew together, and 65 years we were married together. She died. We tried the best in the world to save her. I mean, the battle which we fought against the air accident and cancer and all, but ultimately nothing could be done. So then what you leave into a situation. Naturally, as a lonely man, you get depressed. Now, this is not allowed to affect the functioning of a company. The company work is, you can't be depressed, you have to be positive, active. So I want to detach myself away and then devote the rest of my time in what I would like to do the best in my life. I have tremendous amount of relationship all over the world, friends. I like to visit them, meet them. And then, frankly, I'm quite a dedicated golfer. I'm very active. Earlier, I used to play ball. So I carry my sports. So for me, it is a disconnecting from executive role. Because if I get connected to executive role, I would not be performing the best. Because naturally, if you lose a partner for 65 years, you can't be the same.
It's interesting that you talked about being consciously aware of the need to let go. And many Indian promoters struggle with that. In this phase of restructuring or reorganizing your life and learning to let go, what has been the hardest part?
Hardest part of what?
Of learning to let go.
Realism. Because I'm one of those persons who understand, one is called philosophical, other is realistic. I knew that a business operation requires active involvement regardless of your personal issues. Secondly, positivity. So when you lose a partner like this and you are in 90 years, your reactions become slower. Whereas the company needs actions of a, not that I've slowed down, by the way, not at all. I've not slowed down, but I've slowed down insofar as my responsibility towards the company is concerned. And my son is in fact doing better job than me, taking the company forward in a very high trajectory with the same values which I did.
Inspiring person, inspiring conversation, and you can catch that entire conversation today at 5 p.m. on CNBC TV18. Moving on, IDFC First Bank's V. Vaidyanathan was also awarded at the event. He was named the Entrepreneur of the Year in the Financial Services category. My colleague Jude caught up with IDFC First Bank's MD and started off by asking him about the credit demand and the prospects for Indian lenders at large.
I think our bank is doing wonderfully well. We're very excited for the bank.
Right. What do you think has been the single most deciding factor when it comes to recognizing the work that you've done in the last year or so, Mr. Vaidyanathan?
Well, I think, as you know, a lot of people shape us in our lifetimes, as you know, like from a family, from children. Mr. Kamath was a wonderful personality whom I learnt a lot in life. A couple of my teachers who were with me in school are here today. And I just thought of people who might be very happy to see me here today. And I brought a couple of teachers with me.
Right, moving on, I have to ask you, given the way that we're poised as far as the economy is concerned today, what kind of credit demand outlook do you see? Do you think that's going to come from CapEx going forward?
Well, overall, you saw credit demand is pretty strong last year, like upward of 17% or so this year. Things will calm down, but I still think because the underlying factors in India are so strong, and you know all of them, I think we are in for a good cycle in the next 8 or 10 years.
Right. But do you think rising lending rates have really hurt the demand for credit at the time and place we find ourselves in?
You can't see any, at this point of time, you can see the credit numbers are growing upward of 16-17%. But really, I think that the demand in India is so strong that I think these are all a cycle. It'll pass, the demand will live through the cycles.
Right. Do you think margins are also going to be possibly impacted owing to the fact that deposit rates could also see some increase going forward?
Some tapering is to be expected because at least from here on, because deposits have now begun to rise, deposit rates are now begun to rise. I think, but again, we should look through the cycle. We could look at the long term, and these small things about margin change, interest rate hike, these are temporary activities.
Last question before I let you go: what kind of asset quality outlook are we focusing on, and we can expect for 2023? Do you see the loan book, for instance, shaping up?
Well, since you asked me for our bank, asset quality, I can say is looking very, very good. Many people are saying, oh, you're just having a benign cycle. I believe that India structurally gotten better because of India's credit bureaus come of age and all the technologies have come of age. I believe so.
Okay, so that was Mr. V. Vaidyanathan. By the way, keep your eye on the Zee Entertainment stock. There are some very, very interesting and very heated discussions that have happened at the NCLAT, which is where the hearing has been underway. The real contention here is whether Zee Entertainment took on the entire guarantee for the loan of Citi, whether it was the guarantor for the whole loan, which is what IndusInd Bank is arguing, or only a part of the loan, only the interest, which is what Zee is arguing. So very, very heated debate going on at the NCLAT. The other very contentious point in this sort of whole argument is Zee saying that it was not allowed to argue its position before the NCLT. Remember, the matter first went to NCLT, and NCLT then looked at admitting the insolvency plea. So Zee saying we never got a chance to argue, which is something that IndusInd Bank is contesting. IndusInd Bank saying that no, Zee had all the opportunity to present their arguments before the NCLT. Zee's whole contention is that there needs to be a stay because what has happened at the NCLT is a violation of the principle of natural justice. Extremely interesting arguments going on in the courts, and I think over the next perhaps few hours, we don't know if it's today itself, but we'll watch this space with Ashmit. He's the man tracking the story for us. We are expecting the NCLAT to come out with an order. Right now, Zee is absolutely flat. The market's hope and expectation is that the deal may get delayed, but it will not be derailed. Let's see what happens. Zee is an important stock to keep in mind. And with that, we are out of time on this edition of Trading Hour. Thank you very much for watching. Do stay tuned. Halftime report will take the action forward.